Let's visit the Heavenly Soul Shoe Boutique again and go through some sales transactions. Assume the boutique sold $500 in shoes to a customer on account. Anytime we have a sale of inventory, there are 2 journal entries recorded. One entry deals with the sale and sales price, and the other entry deals with the inventory and its cost. For now, we'll just focus on the sales side and leave the inventory entry for the next module. The journal entry for the sale would be a debit to accounts receivable for $500 and a credit to sales for $500. Perhaps this customer is one that we do a lot of business with regularly and usually makes large or bulk purchases with us. We have extended a trade discount to this customer. A trade discount is a type of discount that is calculated on the sales value and deducted as if that is a new sales price. Assume Heavenly Souls gives this customer a trade discount of 20%. In that case, we would not make the previous entry. Instead, we would deduct the trade discount prior to recording the sale. The trade discount on this transaction is calculated as $500 times 20% equal to $100. We deduct this from the $500 original sales value and record $400 instead. The journal entry would be a debit to accounts receivable for $400 and a credit to sales for $400. There are also other situations where we could reduce the original sales price. These include sales returns, sales allowances, and sales discounts. All of these are what we call contra revenue accounts. Anything with the word contra means it's contrary or opposite. In the case of a contra revenue, that means these accounts act in the opposite manner of a regular revenue account. Contra revenue accounts are increased with a debit and have a normal debit balance. Sales returns are used when a customer returns something that was purchased. Let's use that original shoe sale example. We sold $500 of shoes, but a few days later, the customer comes back to the store to return one pair of shoes. That pair of shoes was sold for $120. To record this return, we would use one of the new contra revenue accounts by increasing the sales returns account with a debit of $120, and we would decrease the amount the customer owes us by crediting accounts receivable by $120. The customer now owes us $380, which is also the amount that the customer's accounts receivable balance now is. What if a customer wants to return something, but we don't necessarily want it back? Maybe the items were sold and shipped but arrived damaged, or maybe the items were not the correct items. The store can give the customer an allowance instead of requiring the customer to return the items. No inventory is returned to the store, but the customer's account is decreased as if it were returned. The sales amount of the items is debited to sales allowances and credited to accounts receivable. Companies may choose to use only one account for both sales returns and sales allowances, called sales returns and allowances. Companies can also give their customers a discount. Ever used a coupon at a business or received a discount because you were a student? Those are types of sales discounts. Unlike a trade discount, a sales discount records the amount of the original sale and also records the amount of the sales discount. Assume our customer that bought shoes had a coupon with her for 10% off her purchase. If she used the coupon, we would record the transaction with a debit to sales discounts for $50, the $500 purchase times the 10%, a debit to accounts receivable for $450, and a credit to sales for $500. We still sold $500 worth of shoes and want to record that amount. We also want to keep up with the discount amount in a separate account so we can keep track of how much we gave in discounts over the period. And the customer only owes $450 now because she took a discount off the price purchased. So that's all she owes us, and that's all we want to have recorded. All of these contra revenues reduce the amount of original sales we have. The amount of original sales is called Gross sales. In our example, gross sales were $500. The three types of contra revenues, sales returns, sales allowances, and sales discounts, all reduce this amount. Once we deduct these accounts from gross sales, we get something called net sales. Net sales are the amount we will actually get paid. That is, if everyone pays us.